The committee made the announcement after holding its 95th regular meeting from Wednesday to Friday, July 24, to review developments in the economy. Given reasons why the policy was maintained at 14.5%, the governor of the Bank of Ghana, Dr. Ernest Addison, said this is necessary to ensure stability, looking at the current extraordinary circumstances, and also help cushion various businesses amidst the COVID-19 pandemic.
The committee was of the view that the current extraordinary circumstances, with a widened budget deficit and residual financing gap, would require some monetary restraint to preserve the anchors of monetary and macroeconomic stability. In the circumstances, the committee decided to maintain the policy rate at 14.5%.
In March this year, the MPC reduced the rate by 150 basis points from 16% to 14.5%, and the figure was maintained in May 2020. The most recent data on the Ghanaian economy shows that the pandemic has impacted adversely, resulting in a significant growth downturn and higher inflation. The governor also said the MPC noted that uncertainties in the global economy have increased, although investor uneasiness had heightened. Touching on inflation, a key driver of the policy rate, Dr. Ernest Addison said inflation is currently above its upper limit and is driven mostly by food prices. According to him, underlying inflationary pressures are stable, which drives the bank to project a return of inflation to medium-term target band by the second quarter of next year.
The Bank of Ghana's latest forecast shows that inflation is currently above its upper limit, driven mostly by food prices. Adjusting for the unusual noise in the food inflation, the indications are that underlying inflationary pressures are stable. The bank projects a return of inflation to the medium-term target band by the second quarter of 2021, conditional on corrective fiscal measures being introduced in the near term.
The governor, however, expressed fear about the huge financing gap brought about by the expanded deficit, saying it could exert pressure on public debt, which could culminate in a long-term implication for the economy. He also asked that certain sectors of the economy, such as the services sector, have been adversely impacted, thereby increasing non-performing loans.
Sectors mostly affected by the pandemic and consequently loan repayment to the banks and SDI includes the services, commerce, finance, and manufacturing sectors. These conditions have heightened the risk of loan default in the banking sector and is pushing non-performing loans up. Total asset base of the banking industry continues to remain strong, with the total asset base expanding by 23.2% in year-on-year terms to 139 billion Ghana cedis at the end of June 2020. The committee noted that the COVID-19 pandemic has pushed public finances out of the path of fiscal consolidation. The fiscal deficit is expected to expand to 11.4% of GDP by close of the year. The huge financing gap brought about by the expanded deficit could exert pressure on debt, with long-term implications for the economy.